Good morning, everyone. Welcome, a very warm welcome to you all today. For those watching in hindsight on video later, today is Friday, the 17th of March. It's 10 o'clock, and we're going to start our webinar now. We're going to talk about the spring budget that took place on Wednesday this week. And I'm very pleased that I've got three fellow tax directors helping me today. Who will speak in this order: Graeme Hills, who's head of private client, Christine Newitt, head of VAT and duties, and Matthew Appleyard, head of corporate tax. Our plan is to speak for just over an hour, I would guess. We've allocated until 11:30 to include some time for questions, and our panel will answer those as best we can. There is a function on the top of your screen towards the right where there's a Q&A box. Please post your questions there, and we'll endeavour to answer those at the end after the presentations. My role is to introduce the event and just talk briefly about some of my takeaways from the budget on Wednesday. I think there were three things for me that I wanted to mention before I started my formal presentation. The first was about the energy support. It was widely expected that the Chancellor would extend that. I think it was announced actually in the morning just before the budget speech itself, that the support for households would be extended until July. What I think was far more welcome, and actually I was surprised, almost shocked that this has never been tackled before, was about equaling up the rate at which people with prepaid electricity meters pay for their electricity, being the same as direct debit. So I find it quite amazing that it's taken us that long to get to that stage, and that was certainly something I welcomed with open arms. A bit of a joke. There seems at the moment the in-joke is about swimming pools. The leader of the SNP asked a question to our Prime Minister Rishi Sunak about his new swimming pool, about his upgrade on his electricity supply, and sure enough, Jeremy Hunt, the Chancellor, came back with a bit of a quip about £60 million for local leisure centres, which I'm sure is very welcome. Not quite sure why swimming pools is the in-joke at the moment, but it must be because of Rishi himself. And finally, on a personal note, I was very pleased with the Brexit pubs guarantee. Always nice to have a cheaper pint in the pub and with a convivial atmosphere. I think going to the pub for me is a great thing to meet people, which I'm sure many of you will be aware that I do. Well, I'm going to just share my slides with you now, if you'll just bear with me while I do that. Okay. One of the things that I wanted to talk about was just the overall economic background and situation we're currently in. Chancellor Jeremy Hunt talked about the Prime Minister's economic priorities, of which there are three. The first of which is to halve inflation. Well, judging from the Office for Budget Responsibility, that appears to be well on track. They're expecting that inflation will drop to just below 3% by the end of this year, by the end of 2023. The second one was about growth, and I think there was some relief that there's going to be technically no recession this year. There is actually a small drop in GDP of 0.2%, but not enough for us to have two consecutive quarters, and therefore there's no technical recession. I have to say the growth looks pretty low. You look at the next few years, the highest point I think it was in 2025, when it will peak at 2.5%. Does drop away quite alarmingly, I think, by 2027 to 1.9%. Not great growth figures as far as I'm concerned. It'd be interesting to see what effect the measures will actually have that the Chancellor announced. He talked about the 4 E's of enterprise, employment, education and everywhere. I won't touch on those points. I wanted to focus on the third of the Prime Minister's economic priorities, and that is reducing debt. This slide, which I hope you can see, is a chart back from the late 1990s all the way through into the forecast past the current year. of net debt as a percentage of gross domestic product, GDP. What you'll notice is that the forecast is for it to continue to rise as a percentage of GDP. It peaks in a couple of years' time at 97.9% of GDP. That sounds quite frightening. I've become pretty immune to it really now. I used to worry about how much the government had borrowed. I don't anymore. It's currently standing at about £2.5 trillion. And the Chancellor was very frank about it in terms of saying that as part of the G7 we are not the lowest, sorry, I should say the highest as a percentage of GDP. He referred to other countries that have a greater percentage of debt to GDP, being the USA, Canada, France, Italy and Japan. So in that respect, I suppose we perhaps should stop worrying about the debt that we carry. My next slide, therefore, is on the annual deficit. And what you'll notice on this slide, this also goes back to the late 1990s. And what you'll notice, this also is a percentage of gross domestic product. And what you'll notice is that the zero is quite low on the chart. And since, it seems to me, since 2002, we've always had a deficit. The peak, of course, came as part of the pandemic. And Jeremy Hunt referred to the issues of the pandemic and more recently the energy crisis, which has caused the government to borrow more money than perhaps they would have wished. But interesting that even by 27 to 28, it is still almost 2% of GDP in terms of annual borrowings. Perhaps if we put that into real numbers for you. Sorry, I'm one slide ahead of myself. This one, I'll do real numbers in a minute. This one shows us the debt interest. So I want to just touch on debt interest. If you've heard me speak before, you'll know that I refer to the trillions of debt rising in recent years. And it first hit £1 trillion in 2010, and then we hit 2 trillion in 2020. So you can see it's rising quite quickly, but it's affordability that matters, and this shows how affordable that might be in terms of a chart showing debt interest against government revenues as a percentage. You'll see there's a dotted line across the middle, which is the average of that period from, again, back from the late 1990s, which is just over 5%. And you'll see that, again, it's not the pandemic so much that's caused that to rise, but actually more recent events in terms of the actual bank base rate and, of course, the knock-on effect of government borrowing rates. And it peaked at just over 10% now of government revenue in terms of that debt interest, which is it's a huge amount to pay. You'll see the forecast drops very suddenly. That's not to do, of course, with debt reducing. That's to do with interest rates reducing. So has some benefit, and of course has allowed Jeremy Hunt to perhaps be a little bit more generous than he might have been and not raise any taxes this time. Well, we will see. So yes, this is the slide I was referring to earlier. So this shows the difference between the borrowing forecasts since the November forecast when we had the autumn statement and now the March forecast. So they're the first two rows on the chart. And you'll see that even though there's a vast improvement in the 2022 to 23 year, that was 177 billion in November's forecast. It's now 152 billion. So, and it doesn't really drop hugely, does it? You look right across to 27 to 28, and we've still got a 49 billion pound deficit annually at that point. So, which means I think we're going to get to about 3 trillion by about 26 to 27 year in terms of the March 23 forecast. The only other point I wanted to just highlight was the movement, therefore, in debt interest spending. That's about a third of the way down the chart. You'll see underlying differences as a heading, and then the middle of those is debt interest spending. And you'll see that that's reduced substantially in terms of the forecast since November, having now improved to March. peaking now at what, 12.8% in this coming year. So really some good news, and I don't want to, take up all of that time in terms of just talking about the public finances. I know we really want to talk about what impact that has on us as individuals and businesses. So I'm now going to pass over to Graeme Hills. Graeme Hills, as I said, is head of private clients, and he'll talk to us about the impact on us personally. Graeme, can I now hand over to you?
Thank you, Nick, and good morning, everyone. Yes, indeed, we're going to start off having a look at the impact on us personally, us as individuals. Christine and Matthew will be covering the details for businesses going forwards. But first of all, how does this impact on us? For those of you who read a lot of the pre-budget speculation that came up beforehand, there was a lot of talk about this being a very dull budget. If you're like me, I'm sure you can't imagine such a thing as a dull budget, but it was overall very vanilla, very bland. There were no great big sweeping changes that we saw from a tax perspective. Most of the changes that did come through were largely either already pre-announced or at least leaked beforehand, so we were aware of most of them coming through. But even so, it's useful for us to have a look through about what's been announced beforehand, where we are with all those changes, and what we should be doing about those changes to come. So we can start off looking at the personal allowances. This is something that was talked about in the autumn statement, and no significant change here. If you're listening to the Chancellor on Wednesday, he was talking about £1,000 a month tax-free that you can earn in the UK. This is where this figure comes from. It's your personal allowance. It's the amount you can receive without paying any tax on it. It's currently set at £12,570. This year it's the same as last year. That is now frozen until 2028. So that's an awful lot of years for that to be frozen. Historically, this was much lower. Gradually increased as part of a manifesto promise to increase this to 12,000, went a bit further to 12.5, then an inflationary increase. It was meant to increase in line with CPI. That is now frozen until 2028. So while this isn't a tax increase, the effect this really has is to mean that you have less of your proportionate income, which is going to be tax-free. So if your income is going to increase over years, this fiscal drag effect, they call it, of the personal allowance, tax-free elements not moving up in line with your income. So if you had income, say 40,000, as a proportion of your income that is tax-free, your income goes up to say 45 in a few years' time. That personal allowance remains the same. You don't get any extra tax breaks that move up in line with your income that hopefully follows inflation and covers those costs. The transferable allowance is in line with that, so that remains the same, and blind person's allowance and married couples allowance also frozen. So that will be a long-term thing and nothing to change until 2028 as things stand. Similarly with income tax rates, looking at the basic rate band, so this is the element that usually pay tax at 20% and then increases to 40 once you get into the high rate bracket. That is also frozen at this 37,700 limit, bringing your basic rate band to just over 50,000, including your personal allowance. And that again is frozen. So again, you're going to have that same impact. If, for example, your income is around the 50,000 limit, you'd very quickly start to see this as your income sort of tips over that 50,000 limit. You start paying tax at 40% on that bracket because your rates aren't moving with it. Your income increases might only be inflationary, but the tax rates aren't moving with it, and you're going to have a higher percentage of tax compared to your overall income because those tax rates aren't tracking your income with it. One thing to note on here is the upper end of the high rate band, where you start paying this additional rate of 45%. That is reducing with effect from a couple of weeks' time. This was announced previously, but it's actually happening now. So previously at 150,000, you started to pay tax at the 45% rate. That is now being reduced to 125,140. If you're curious about why it's that peculiar figure, this is all to do with the personal allowance abatement. So if you have income over 100,000, that your personal allowance, your 12,570 that we talked about before, is reduced by £1 for every £2 by which your income exceeds 100,000. So at 125,140, that personal allowance is lost completely. So what this means is, although the actual tax rate remains at 40%, during that band between 100,000 and 125,140, you're paying tax at an effective 60% rate. So you're paying the high rate tax of 40%. You're also losing your personal allowance and paying another 20% on that as well. So there's a band where you actually pay an effective rate of 60%. What they didn't want by reducing it to a nice round 125,000 was having £140 of income at the 65% rate, because that would be, although it's only 5% on £140, it does create a headline rate of 65%, which obviously they didn't want to encourage. So that's the rate we've currently got. What this means in practice is, if you are able to control your income, perhaps if you're taking income from your own company, then you might want to consider whether you want to accelerate any of your income over the next couple of weeks. Certainly if you're in that sort of 125 bracket already, you might want to consider moving some of that forwards, paying the tax at the 40% rate now, rather than incurring it at the 45% or even that 60% rate, if you can control that next year, and front loading some of that income if you have that option available to you. Dividend income, it's already increased the rate on dividend income. You must have been familiar with the old 7.5%, 32.5% and 38.1% rates, and these have all been increased by 1.25 with effect from last April. This was all in line with the health and social care levy that was due to come in, which was a temporary national insurance increase, and also then it was due to be a health and social care levy from this April. That was all abandoned in November. That was all removed, but the dividend rates remained. There's no reduction in those back to the old rates. The 1.25% increase on dividends has increased. So when you have your tax bill next January, you'll start to see that if you've paid yourself any dividends or you've received any dividend income during the year, that tax rate has increased. One thing that was announced in the autumn statement was the dividend allowance is changing. So this is the amount of dividends that you can receive during the year and not pay any tax on them at all. Currently that sits at £2,000, but with effect from a couple of weeks, that reduces to £1,000, and then by April next year, it'll be only £500 of dividend allowance. The idea of this was very much that if you have a small number of shares, perhaps from an employee scheme, for example, then you didn't want all these people being self-assessment. So it gets a few people out of self-assessment by giving them a small allowance. And the general thinking was that £2,000 was more than enough. And really, if they reduced that to £500, it wouldn't haul too many people back into self-assessment. It would just be a bit of extra tax on people who already have this investment income coming through. What this means for you really is, obviously, if you have, again, that control of the company, perhaps you have reserves, make sure you're using this dividend allowance. It might only be a small amount, but over the years it can soon add up. And again, you'd rather have paid yourself that extra £2,000 now while you can, rather than think about it on the 6th of April and realise you missed the opportunity. So do be thinking about whether you want to be paying yourself a bit of extra dividend to make the use of those allowances while you've still got them. National insurance, the rates has increased here. It's 12,570. That figure looks very familiar because it's the same as the personal allowance. This has been a goal for some time to align the national insurance and income tax rates, and this has finally happened. So that is currently the rate at which you'll pay 0% national insurance, which again is why the Chancellor talked about no one paying tax on national insurance on their £1,000 per month. This figure is now aligned. Again, the 12% rate also aligns that 5270. That's the same as your 12,570 plus your 3,700 for the basic rate band. Those rates are also aligned, which vastly simplifies things. Rather than thinking you've got a different rate for tax and national insurance as we've had for many years, they are now aligned and the same. One thing to sort of note as part of this is the state pension credit that you get. So to qualify for a full state pension, you need a number of qualifying years, and to get a qualifying year, you have to make national insurance contributions. Now the way it actually works is there's a lower threshold, which actually isn't the same as the personal allowance, and you can actually qualify for a qualifying year by having income above this threshold without actually paying any national insurance. This might be around £6,000–7,000, paying yourself this income, and you're still qualifying for the state pension. So there's a lot of people that did this at the lower end just to make sure they didn't pay any tax and national insurance. Obviously, if you're in that position, you can now pay yourself a bit more if you'd like to, and still not pay tax, still not pay national insurance, and be much higher up near this 12,570. An alternative view that some people took as part of this state pension qualifying years approach was they were concerned that if there's no national insurance on the record, you might then have a bit more of an argument with HMRC when the time comes to claim your state pension that it was a qualifying year. And some people took the view that actually I'd rather pay a few pounds of national insurance each year, so I've got something on my record. If you're in that category, you might have been only paying yourself, say, £8,000 a year to get that small amount of national insurance on the record. So you might then have to have a proportionally quite large increase in your salary to get over that 12,570. So something to be thinking about for next year about how you want to structure your remuneration if you have a choice in that regard. Again, these rates are frozen until April 2028, so we're going to have the same fiscal drag effect on these as well. And the 1.25% rate is mentioned at the bottom there, so that was reduced with effect from 6th of November 2022. For the employed, this is very straightforward. You paid the 1.25% on your salary up to November, and thereafter you didn't, so your rates were reduced through the PAYE system. So for the self-employed, again, we have very similar rates, the 12,570 and the 5270. They track exactly the same. The Class 2 rate has increased from 315 to 345. If you're not sure what the difference between those is, it's the Class 2 is the rate you pay a standard flat rate for being self-employed. So self-employed individual partners will pay that flat rate per week, and that's the bit that gets you your state pension credit. The Class 4 doesn't really get you anything on that regard at all. It's really just another form of tax with a different name. One point to note on there is the 9.73% rate for the current tax year we're in. This is because of the removal of the 1.25% surcharge, the health and social care levy that was meant to be coming in had to be put in as national insurance. Unlike PAYE, where the insurance is paid as you go along the year, self-employed pay all of theirs at the end as part of self-assessments. Instead, they just had an average rate. So that is basically the half a year of 1.25% to get you to your 9.73 and your 2.73 for higher rate taxpayers. Very briefly on the national minimum wage, this is something again that was announced beforehand. Very large increases of 9.7 to 10.9%. Obviously, for a lot of businesses, wage costs will be one of your highest expenses most likely. And if you employ lots of national minimum wage employees, you're going to have this large increase, and that is coming in. That is mandated as well. So I'm sure you're already aware of that, but that is coming in from April, and quite large increases to take account for. So moving on to capital gains tax. Before pretty much every budget, there's lots of speculation about whether the capital gains tax rate is going to change, particularly with the current economic position. Do we need to raise a bit more finances? Capital gains tax is often deemed one of those areas that could be looked at, largely because it's at one of the lowest rates it's been for some time. You can see at the bottom of your screen there, the standard rate of 10% of capital gains tax for a basic rate taxpayer, and 20% for any higher rate taxpayer and above. Are very favourable compared to the income tax rates of 20, 40, 45 we've been talking about. Historically, capital gains have been taxed at income tax rates. It's only now that they're being taxed at different rates. There's always been a bit of speculation about whether they will increase to those income tax rates and effectively double or more. But as yet, this has not happened. There's no change to the capital gains tax rates announced at all. So we remain in this 10 and 20% rates, or 18 or 28 for residential property. And that remains the case with no talk of changing that in the near future. But again, we'll have to see if anything changes in that regard. And business asset disposal relief is also often talked about as something that might be changed or removed in some way, shape or form. This allows you to sell a part of your business and receive 10% capital gains tax on your first £1 million of gains. But again, no changes announced to that either. Change that we were aware of from last year, again, came out in the autumn statement, was a reduction in your capital gains tax annual exemption. So this is the amount of gains that you can receive during the year and not pay any capital gains tax at all. So that's currently, as we sit here today, sat at 12,300. That is due to reduce to 6,000 in a couple of weeks' time, and then £3,000 from next year. Trustees get half of that each time, so that's the 6,150, your 3,000, and your 1,500 that you see on the screen there. So again, what this means is if you do have gains that are looming, if you're going to be incurring gain in the near future and you expect to be crystallising some of these, to be thinking about whether you should be crystallising those in the next couple of weeks rather than thereafter, because that could be quite a significant difference in your annual exemption if that's going to make a big difference to you. Certainly worth considering accelerating some of those gains if you want to. But also one of the big differences from a practical perspective, if you have a large investment portfolio, perhaps a stockbroker looks at these for you, they might frequently do an exercise where they sell some of your gains to crystallise some of this annual exemption and basically give you a tax-free uplift in your base cost of assets. That isn't going to be possible to quite the same degree. Obviously, this is quite a valuable thing, 12,300, or you can double that with a married couple, of course. Get that being halved and then quartered down to £3,000 in a year's time. That's going to make that planning far less valuable. So again, make the most of what you can while you've got it, but those rates are going to be reduced going forwards. Capital gains tax on divorce was mentioned as part of the autumn statement. So currently, if you're a married couple, any transfers between spouses are outside the scope of CGT. You will not be subject to CGT on those transfers. And that relief is currently extended to the end of the tax year in which you separate. And thereafter, it follows the normal rules. But obviously, this creates a lot of issues. If, for example, you would separate at this time of year, you've got 2 weeks to sort out all of your financial affairs and without paying capital gains tax. And then all of a sudden, the tax bill becomes a big issue in the negotiations of the divorce thereafter. The government realised this caused even more problems at a difficult time, and therefore this relief on the CGT is extended to 3 years after the year of separation. That's with effect from transfers from this April coming. So that make that relieve a lot of that pressure and make a lot of the tax burden not part of that problem, when there are plenty of other things to be sorting out. And there's also an extension to that for individuals maintaining interest in the family home. So, for example, if one spouse gets to stay in the house, but the other spouse says, well, how do I get my value out of that? They can now still benefit from principal private residence relief. And if the house is sold in the future, there's some uplift in it, they can still get into a tax-free treatment as if they were still living in it, or to take account of the fact that they were living in it for some time. So much more generous relief on divorce there. So the big change that was announced on Wednesday was the pension lifetime allowance. So the way this works is you can have a certain amount in your pension pot without paying any additional tax on it. But once you get over this lifetime allowance, you end up paying a lifetime allowance charge, which is 55% of the excess. So quite a heavy burden, and obviously that negates a lot of the purpose of having that pension pot in existence. Historically, this was going back to 2011. This was £1.8 million lifetime allowance. It's gradually come down over the years, 1.5, 1.3, down to £1 million, and then bumped up with inflation to get to this figure that we currently have of £1,073,100. There's a lot of rumour and speculation beforehand that this would be increased back up to 1.8, and instead the Chancellor removed the limit altogether. So no lifetime allowance from April this year onwards. The purpose behind this was to try and encourage people back to work. It's very much part of the employment E that Nick mentioned, of the 4 E's that the Chancellor was discussing, and trying to get the over 50s, particularly doctors, back to work. There was a lot of representations made on behalf of the medical community that for doctors there's very little incentive to carry on working well into your 50s, because once you maxed out your pension pot, there's very little reason to stay around. You can't put any more in, and a lot of the benefit of working in those industries is that the pension bonus, and therefore this is part of the plan to get people back to work, give them an incentive to come back and put more into their pension pot as a result. The wording on HMRC's release on this was quite interesting. First of all, they said that the lifetime allowance charge would be removed from April 2023 and then abolished with effect from 2024. A couple of theories on why that is. First of all, it may just be parliamentary process, that you can't just abolish something that quickly. But some of the more sceptical people think it's actually given them a bit of a way out of this as well, potentially. One of the main risks they identified was whether it has the behavioural effect that they want it to have. Will it bring people back into work, or will it actually force people to dump a load of cash into their pension pot and retire earlier, which might even have the completely opposite effect of what they wanted. So I think they're giving themselves a year to have a look at it and see if it's actually what they want to do. There will be no charge for next year, but then it's whether they abolish it altogether. Currently that's what's tabled, but they do have a way out if they wish to change that. A quick mention of the tax-free cash element. Currently you can take out 25% of your lifetime allowance, your pot, tax-free. The tax-free lump sum. So a lot of people are getting very excited if they manage to get their pension pot up to £4 million. Can I take £1 million out tax-free then? But no, they've already seen that coming, and the 25% is a cap of 25% of the current lifetime allowance, the 1,073,100. That's where it gets that figure on your screen there of 268,275. So no matter how big your pension pot gets, that 25% tax-free lump sum will be capped at 268,275. In order to make this a attractive proposition, you need to get more money into your pension, of course. Currently, this is capped at the tax relief amount of £40,000 per year that you can put into your pension. That's going to be increased from next year by 50% to get up to £60,000 per year that you can put into your pension. So there's a lot more that you can save as a result of that. There's also a tapered allowance, which is basically if your income is in excess of the adjusted income limit, your annual allowance is reduced again by £1 for every £2 by which your income exceeds that adjusted income limit. Currently that's £4,000. No matter how high your income is, you can always put £4,000 into your pension. That's coming up to £10,000, and the adjusted income limit goes up to £260 as well to give you a bit more leeway and tie in with that annual allowance increase as well. So a lot more that you can put into your pension, and a lot more benefit to it being there as well. Inheritance tax, I can't remember how long I've used this slide for. I think it was a huge surprise that I could put something else in it in August, sorry, in the autumn, get that third time lucky, where this was frozen until April 2028. Obviously, these have been practically frozen for some time. There's been no change in these rates for a long period of time, so that these rates remain the same. And again, with growing estates, these reliefs are becoming less and less valuable, and more people are being pushed into paying inheritance tax. It is something worth a look, but still no changes to the fundamentals of inheritance tax. Things like business property relief, agricultural property relief, still in existence, and although there's lots of speculation that someday those will change, that hasn't changed yet. There was a consultation on the taxation of environmental land management and ecosystem service markets, which is a lot of it's looking at certain forms of farm diversification, how farming is taxed. There were a couple of comments in there in that consultation about agricultural property relief and how some of that operates. So it is something that's generally being looked at, and there may be some changes in the future. Certainly that's something that's on the radar of the government, but as yet no changes announced. This is an old slide. I thought it was just worth raising that HMRC have put an awful lot of investment in recently. This is a figure from a couple of years ago about how much they're putting in, and we're starting to see the effects of this, mainly in how HMRC are opening investigations and inquiring into things. Matthew's going to talk a bit later on about the research and development challenges that we've had recently. We are starting to see these come through. HMRC are physically going out there and having these discussions, so that's where this investment has gone. They still can't answer the phone in less than 40 minutes, but the inquiry is still carrying on and are increasing as a result of this. Last point I was going to mention is on making tax digital. So this is about producing quarterly returns to report your income in a digital way. This was due to come in April next year. It's now been put back another 2 years to April 2026. So if you have been getting yourself ready for making tax digital, well done, but you still have a couple of extra years to get fully ready for that. And who's going to be involved in making tax digital has also changed. The income limit has now changed. It was £10,000 if your self-employed income or your rental income was going to be more than £10,000, you were going to have to be included in making tax digital. Now that goes to £50,000. And you'll have to be in making tax digital from 2026. And if you're in the 30,000 to 50,000 bracket, then you've got another year until 2027 to bring into making tax digital. So although it's still being moved down the line, it is going to come into place sooner or later, and you may wish to get yourself ready for that already, looking at the software that's available, giving yourself up so it's not a big change. You've got plenty of time to think about that, but obviously there are other advantages to using that software as well. So be thinking about it. If you know you're going to be in that bracket, you might want to jump earlier rather than later. And the final bullet point now is about basis period reform, which lots of people sort of tie in with making tax digital, but it's completely separate. This is still happening. So this is all about what your basis period of assessment is. If you're a self-employed individual or a partner in a partnership, you're currently taxed on when your accounts year end is. That's going to be aligned to the tax year end with effect from next year. So if you're a 31st of March or 5th of April year end, you don't need to do anything, but you're already paying your tax on a tax year basis. But if, for example, you are a 31st of December year end, you're going to have to think about what you're going to do to account for this going forwards. Do you actually want to change your year end and see what the tax effects of that are? Or do you want to work out instead how you're going to account for those other 3 months difference when you come to do your tax return to make sure those extra 3 months are accounted for properly? Again, be having that conversation with your accountant, because that's something we can plan for now. You don't have to be thinking about it next year and trying to put figures together. Best to have that conversation now and see what your options are. Thank you very much for your time. I hope that's covered everything you need to know, and I shall pass you over to Christine to talk about indirect business taxes. Over to you, Christine.
Well, hello everyone, and welcome to my section of this, which is on indirect business taxes. Trusting that you've got that on the screen at the moment. Yes, it's just taken a little while for my computer to update at this end. So, indirect business taxes. I mainly head up VAT and duties at Duncan and Topless, and there's really not a lot in the budget this time on VAT. The VAT threshold has remained the same for quite some time, £85,000, and the deregistration threshold at £83,000. Standard rate of VAT remains at 20%, and over the last few webinars that we've delivered, I've been looking across Europe as well to see whether there's much appetite for change across Europe in terms of fiscal policy where VAT is concerned, and actually there's no movement as far as I can establish across other countries as well. One thing that has now come in is the change to the penalty regime, which came in for VAT on the 1st of January, but it's really only going to properly come into effect at the end of this quarter. So 31st of March 23 quarter is the first quarter that the new penalty point system for failure to file a VAT return on time will come in. There's no transition from the old regime, which was the default surcharge regime. So effectively that finished at 31st of December, and we're now straight into the new system. So for quarterly VAT filers, which are the majority of taxpayers, you need to get 4 points before you get into a fine situation, which will take you to the end of this calendar year effectively, so December 23. If you're on monthly submissions, then you'll be collecting 5 points, so you'll be into the new system much sooner. So the message is clearly to file your VAT returns on time. Late payment charges, so not only are there penalties for failure to file on time, but also failure to pay on time. Now the penalty, the late payment charge, is different to late interest, so you will still get charged late interest if you don't pay on the normal due date, but you won't incur a penalty in addition to that if you pay within the first 15 days of the due date. And HMRC have said that they will extend that in this first year to just get people used to the new system to a 30-day period. So if you are 30 days late just for this year, so up to the December 23 VAT return for those quarterly payers, then there will be no penalty, and then there's a tax geared penalty after that 30 days or 16 days once we get fully into the new system. There's a couple of, these are really housekeeping points to do with VAT relief. So in relation to the primary care sector, prescriptions are 0 rated for VAT. So when you get your prescription from the pharmacist or your dispensing GP practice, that is 0 rated for VAT purposes, so you won't get charged VAT. There are certain groups of patients with complex requirements that can be dispensed without a prescription, and these are dispensed under patient group direction. So it's just extending that relief to 0 rate for those types of written instructions under patient group directions. There's also an extension to the healthcare exemption in relation to medical care services that are supervised by health professionals. And this has now been extended to include pharmacists where they are supervising healthcare services. So these are services that may be carried out by other healthcare professionals who are not pharmacists, but as long as they're under the supervision of a pharmacist, they will still receive the exemption from VAT. Energy measures, as Nick mentioned at the beginning, we were aware just before the budget announcement of the energy price guarantee for households for another 3 months. I think in January of this year there was announced the energy bills discount scheme for businesses, which will be for the full year from April 23 through to March 24. So that was an announcement back in January. But focusing on households, the government are using VAT policy to try and reduce carbon emissions. So energy saving materials ordinarily would attract a 5% VAT rate, and last year in April 22 that relief was reduced to 0 rate, and this is for certain energy saving materials that are installed in your home, and there's a list on the screen there of those that will currently benefit from the 0 rate, and that will expire in March 2027 as things currently stand. But on budget day, the Chancellor also released a consultation regarding whether other energy saving materials should be added to that list for VAT relief. One of the specific suggestions in the consultation paper is whether battery storage should be added to that list, whether that be a standalone technology for battery storage or battery storage that's retrofitted to an existing solar panel installation. The consultation is also asking the industry for any other technologies out there that they think could be of benefit in improving carbon emissions and energy efficiency in buildings. So any proposals that the industry is putting forward will be considered as part of this consultation. So if you are in that sector, it's always worth. I'm always surprised how few people respond to consultations. So if it is a sector that you're in, I would encourage you to try and get your technologies within that zero rate for VAT relief. Also in that consultation document is a question about whether relevant charitable purpose buildings should also have the benefit of the VAT relief at zero rate where energy saving materials are fitted. Currently this only applies to residential property, installations in residential property. It did at one point in the UK, several years back now, probably 15 years ago, the lower rate of 5% did apply to relevant charitable purpose buildings, but the UK government was taken to the European Court and it was agreed that it was ultra vires the EU VAT directive. So we had to withdraw that relief from charities. So the question is now, should it be reintroduced now we're no longer within the European Union jurisdiction for VAT? This wasn't announced in the budget, but I did think that there would probably be some lawyers on the webinar today. And to just make you aware that there are some changes to the option to tax procedures that came into effect from the 1st of February. So these are quite recent changes. And there's no changes in relation to the option to tax itself. It's just the procedures that HM Revenue and Customs will be following. So there will no longer be issued the notification letter that businesses are used to receiving and which lawyers are used to asking for when properties are being sold. That will no longer exist. So any options to tax that are notified after the 1st of February, you will not receive that letter. HM Revenue and Customs will still write to you if your notification doesn't include all the information that they think they need. So you may receive a letter from them to just ask for further information. The notification of an option to tax should be sent by email because that is the only way you'll get any sort of automated response back, which you should then keep for your records going forward. There is only a statutory requirement to keep records for 6 years, but as an option to tax is valid for 20 years, we would advise you to keep that acknowledgement of the notification permanently until such time as you want to sell the building, and then when your lawyer asks for details of the option to tax, that's the evidence you'll be able to present. I think Graeme has already intimated that it takes the revenue quite a long time to answer the phone. It takes them even longer to respond to a letter, which is the only way you can contact the option to tax unit. So better to have that information than have to try and request it. You can still request confirmation of an existence of an option to tax, but only if it's likely to be more than 6 years ago that you notified. And you'll only receive a response if that option to tax notification actually exists. So you'll then just be sat there wondering, have they not replied because their mailing system is response to mailing is so far behind and there's a huge backlog, or is it just because it doesn't exist? So again, another good reason to keep that documentation. However, if you are acting as a receiver or an insolvency practitioner in relation to a particular property, they will respond in that particular circumstance. So you'll be aware that the business rates review has now completed. It's been ongoing now for about 3 years. I know I've mentioned it a few years running now on these webinars. And the Revenue have accepted all the recommendations that have gone through the consultation process. So there is now an obligation on ratepayers to notify the Valuation Office agency within 60 days of any change of occupier of the property and any change of property characteristics. So I think the characteristics, when I was looking at it earlier, are things like any changes that you've made to your particular premises. If the nature of your business changes, then you need to inform them within 60 days. If you sublet any part of your property, you need to inform them within 60 days. Or if you're merging properties, so if you've perhaps got 2 properties that are next door and you're sort of knocking them into one property, you need to inform them. Previously, your only obligation was to respond to the VOA if they wrote to you, but now there will be an obligation for you to actually notify them of any changes. There will also be an obligation to make an annual confirmation each year that you have provided any relevant information of anything that's happened during the year, and that needs to be made within 60 days of the 30th of April each year. The revaluations, as I'm sure you're aware, are now every 3 years, and this system will commence in 2023. Now, the Revenue or the Valuation Office are digitising this process, so they have said that the 2023 listings will be the first ones going into this system. I think you can now join up and log an account with them, but when the online system is up and working satisfactorily, then this system will be properly enforced. What this exercise will also do will link your business rates data to your direct tax reference with HMRC. So there will now be a link between central government and local government in terms of data, and the government have said that this is to better data will better inform them regarding policy on where targeted support may be required. But I'll leave you to make your own mind up on what that data connection might mean for the future. There will be sanctions if you fail to provide information or you provide false information. So just make sure that you are watching out for the new system coming live. HGV levy reform, as you'll probably be aware, the HGV levy was suspended until August 2023. So when we get to August 2023, the new levy regime will come into play. Again, the government have accepted all the recommendations in the consultation document, and they will be simplifying the levy system from 11 bandings down to 3 bandings, and the rates will be related to emissions and environmental quality performance of the vehicle. So effectively, it's going to be the weight or tonnage of the vehicle and the CO2 emissions. And these are the 3 new bandings for those of you that are in the HGV haulage industry. As I say, they will come in from August 23 when the current suspension is lifted. Just a quick note on other indirect taxes and levies. There's a call for evidence around landfill tax reform. Also a consultation issued on budget day around climate change agreements. The fuel duty, the 5p cut from, I don't know, it's 2 or 3 years ago now, maybe even longer, has been extended for a further 12 months. And so there'll be no inflation increase either for 23-24. And plastic packaging tax, which was introduced for those that produce more than 10 tonnes of plastic packaging. This was a measure, if you recall, to try and reduce the amount of non-recyclable plastic. So the increase there's going to be an increase in the rate from the 1st of April from £200 per tonne to £210, 82 pence per tonne. And if any of you are in that regime, you do have to file quarterly returns, and I am going to be giving a little bit of a presentation on an upcoming webinar that we're holding on the 25th of April, which I believe may also cover some of the research and development reliefs as well, which I know Matthew is going to cover a bit later. So that's a webinar for manufacturing and engineering on the 25th of April, 10 o'clock. I'll give you a bit more detail. Just a few other indirect taxes and levies. No change where tobacco is concerned. That escalator is still in place. Alcohol duty, which I think Nick has already mentioned, was frozen until August 23, and now the revised duty structure is in place. So as part of the new levies and structures that are coming in from August 23, there will be an increase in the relief for draft beer and cider from 5% to 9.2%. That's an increase in the relief available. And also for wine and other fermented beverages and spirits, there'll be an increase in the relief from 20% to 23%. Just a quick reminder, which I covered on the autumn statement webinar, the import and export declaration system that HM Revenue and Custom use. The old one was called Chief. It's now moving over to the Customs Declaration System, which is abbreviated to CDS. The old system was switched off for import declarations at the end of last year, and for export declarations that was due to be switched off in March, but that is now not going to be switched off until 30th of November 23. There was a few little hiccups and teething problems with the first switch off, so I think they're just extending it a bit longer. And finally, just a general point on charitable tax reliefs. So tax reliefs are going to be withdrawn for non-UK charities. So non-UK charities can register with HM Revenue and Customs in the UK to obtain various reliefs across all of the taxes. And those reliefs, some reliefs like gift aid, for example, will also apply to donors. All those reliefs are going to be withdrawn for any charity that is registered, which is not a UK charity. So there will be a transition period. So for all taxes where there are reliefs for charities, apart from income tax and capital gains tax, there will be a transition period that ends on the 1st of April 24. And for income tax and capital gains tax, there will be a transition period that will end in the tax year, won't end until the tax year 24-25. So with no further ado, I will hand over to Matthew.
Thank you for that, Christine, and welcome to the impact for corporate entities, which I think just means companies. So we're going to get straight into it. What are we going to cover today? Well, I'm going to give a reminder as to the changes in the corporate tax rates that are up and coming from the 1st of April 2023. I'm going to go through quite a few of the changes that weren't really announced in relation to research and development claims or the innovation reliefs. I'm going to go through the capital allowances and the full expensing that's been announced. I'm going to give an overview of the share schemes, a bit of an update in terms of the investment zones that was announced actually in the autumn, as well as an update on what's happening on all things international. So from the 1st of April 23, we're back into two different rates of corporation tax, which we haven't had for quite some time. For companies that are making profits of up to £50,000, you will benefit from the small profit rate at 19%. For those companies that are making profits of between 50,000 and 250,000, you are in a marginal rate of tax. And actually, for every pound that you're into that marginal rate, you're actually paying nearly 26.4% corporation tax. And then for those that have profits over 250,000, you'll be paying 25% corporation tax, and that is now the main rate. These limits are reduced for those that have shorter accounting periods and for associated companies. So we're back into the associated company rules as if that wasn't more difficult enough. So we're not just looking at those that are in a group, we're actually looking at those that are under common control of the same person or groups of persons. So extra care is going to be needed when considering this. And so we may be asking you a few more questions in terms of other companies that we may or may not act for. For a long time, companies have avoided paying quarterly instalments by splitting their group up into lots of separate entities. No longer. The government are now switched back to what we were several years ago. Closed investment holding companies, so they're companies that are close, so they're controlled by 5 or fewer shareholders, and they are investment companies. Well, you don't get to benefit from the small profit rate. You'll be into a 25% rate of corporation tax. So this is the reminder of what it's going to look like. So profits up to 50,000, you'll be paying your 19%, as I said. And then as we start going through the bands up to 250,000, you'll pay an effective rate differential. Actually, for every pound that you're into that marginal rate, you'll be paying about 26.5 pence on the pounds that you're in. So into innovation reliefs. So the government has reformed these reliefs for several years now, and the process is becoming increasingly complex. The November budget announced step 1 of the merger between the 2 current research and development schemes, being the SME scheme and the less generous research and development expenditure credit, or RDEC scheme. So that's the above the line rate of corporation tax. We've seen in the press, and I'm sure some of you have seen as well, that this has caused some upset in businesses, some of whom are now taking their R&D activities offshore so that they've got certainty over what their investments may look like in the future. We had hoped that this budget would provide almost a roadmap as to what R&D may look like over the period, but unfortunately that hasn't happened. Am I shocked as we move towards the next election? Perhaps not, as the government have remained a bit quiet on what it's going to look like. They have, helpfully or not, in the finer detail of the budget, made reference that the 2 schemes could still be merging into one from April 2024, and a further consultation, other than the one that we've already had, will be issued alongside the publication of the draft finance bill in the summer. So what's happening in terms of the SME relief? So the changes to the rates of R&D relief that were announced in the autumn statement are due to take effect from April 23. The proposed changes mean that loss-making companies were expecting to see their effective rate of subsidy through the repayable R&D credit fall from 33.4% of costs to just over 18.6%. The spring budget has, we've now seen that where loss-making businesses have qualifying R&D expenditure of more than 40% of their total costs, which we understand would be tax adjusted costs. So if you make adjustments to your tax for depreciation, etc., they will also be adjusted for your costs. Well, they'll be able to make a claim for a repayable credit of £27 for every £100 of losses. While these R&D intensive businesses will still lose some funding support from April 2023 onwards, the initial impact will be less than previously expected. There is no similar relief for R&D intensive businesses who have already begun to make a profit, I'm afraid. As has been noted by both Christine and Graeme previously, HMRC have recently issued their one-to-many campaign. So some of you may have received a letter from HMRC giving you a nudge with regards to your research and development activities. This isn't a precursor that you will be inquired into. This is just HMRC ensuring that you are happy that your R&D claim is supported. If you're unsure as to what that might look like, I would suggest that if we haven't made the R&D claim for you, you either get in touch with us or you get in touch with the people that did make the R&D claim for you. There's going to be a lot more. There's going to be a lot more raft of compliance, which I'll get onto in the next slide, as a result of this. The compulsory notification of the claims was announced, so this is part one of a two-part change in relation to R&D. There's no surprise with regards to this one. If you've not been making an R&D claim over the last 3 years, but you are intending to make one, then you will need to notify HM Revenue and Customs of this intention within 6 months of your period end. This legislation is still in draft, and so exactly what's needed to be included in the notification is still to be seen. However, with HMRC's push requiring all R&D claims to be made digitally in the not so near future, this is likely to be an online form that you're going to have to make. So I mentioned about the compulsory additional information. So let me just take you on a bit of a history in terms of research and development. It was originally introduced in 2000 and in 2002 for the RDEC scheme. So it's been around for quite a while. And in recent years, there's been very little from HMRC in terms of checks and balances on the claims being submitted. Quite a lot of the profession has had some, well, more than a little bit of frustration as to some of the R&D boutiques that have popped up around the country that may not always have the client's best interests at heart. HMRC have recently got quite a public kicking from the National Audit Office and in a recent paper also produced by the House of Lords as to the fact that they're just allowing R&D claims to go through. This was a flip from previously where they were inquiring into R&D claims nearly all the time, and then they were told to let more R&D claims go through because they were stopping legitimate claims. I feel a little bit from HMRC, but nevertheless, as a result, they have, in a classic style, had a knee-jerk reaction and gone right to the extreme. And after putting an additional 100 staff members into their R&D team, are seeking to challenge more claims. The problem that we're finding is that the staff that have gone into the R&D team, they don't know much about R&D. They're reading from a script, and as a result, some of the inquiries that have come out to date are actually quite poor. They're asking quite a lot of the time for information that's already been provided as part and parcel of the reports, certainly that we have been submitting. So a bit of a shame, but we'll see as the government continue to try and invest further to tackle this. So what does the compulsory additional information notice look like? Well, hoping to reduce the risk of fraud or error, HMRC have accelerated this requirement to submit details about your R&D claims to the 1st of August 2023. As with the compulsory notification, we're still at the draft stage of legislation, and so we're unsure what the format of the claim will actually, format of the actual form will look like. Whether it will need to just give a summary overview of all of the R&D activities that's been carried out by that particular company, or a detailed write-up of each qualifying R&D activity. We know some clients that have 3, 4, 5, 20 different R&D activities going on during the course of the year. Does this mean we will need to do 20 different forms? Not entirely sure. However, what we do know is that these 6 items that are on your screen right now they're the things that we're going to need to disclose in the summary forms. So what is the baseline knowledge? What advance are you trying to achieve? A description of the R&D activities. Has there been an outcome? If so, what that was, and a breakdown of the costs associated with each project split out across staff members, consumables, subcontractors, etc., etc. Each claim form is going to have to be signed by a senior officer of the company that they're happy that the R&D claim is correct to the best of their knowledge. And this form is going to have to be submitted alongside the corporation tax return. So when I said 1st of August 2023, this isn't for year end starting on or after. This is if you are making an R&D claim that is submitted on or after August 23, this form is going to have to go in with it. So this is going to add compliance burden to many, as the claim forms will have to be submitted alongside. Many of whom have been doing R&D write-ups for a number of years with us or with your local advisor, well, you'll probably be already pretty familiar with trying to provide the majority of this information. But for those that have previously just been submitting numbers on your return, I would encourage you to engage with us sooner rather than later so that we can help you in terms of shaping your R&D claim going forwards. Artificial intelligence. I don't know if, well, if you haven't heard of ChatGPT, I'm about to tell you a little bit about it. So this came out in November and has been huge. Google actually issued a red alert internally once this was launched, and it's quite nifty. The developments have actually shown the powerful potential for technologies which are based on foundation models, including large language models. The issue that the UK government have had was that this was all developed in the US. We are therefore behind the times. And so we're now playing a bit of catch up. So the government are going to award £1 million prize every year for the next 10 years to researchers that drive progress in critical areas of AI. Quantum technologies are expected to have transformative and wide-ranging impacts through development of new types of computers, secure communications, wider improvements to sensing, imaging, timing. And the strategy that the government have set out is quite ambitious in terms of the research and innovation programme. And so they're going to invest 2.5 billion over the next 10 years into this. They've committed to, in their words, lead on the regulation of R&D and the future of web technology, sometimes known as Web 3 or the metaverse. As I said before, I'm very much playing catch up right now, as this is really picking up quite a lot of speed. There's been a number of companies in the press recently who have gone one of two ways. They've either banned their team from using an AI ChatGPT or similar, but there are others that have been experimenting with the AI since its release in November. PwC, for example, have just licensed its 4,000 tax and legal team to use the AI to assist in production. So the question really is for AI is, do we need to get on board now or be left behind, or is this a flash in the pan? Personally think it's the former rather than the latter. It's going to change the way we all work, and hopefully for the better. One of my team members have actually been using the AI a little bit, just seeing what it can and can't do. And he's very keen to ensure that he uses please and thank you with the AI all the way through, just in case it does ever rise up, which I must admit I find hilarious. So capital allowances, goodbye super deduction, hello full expensing. Well, kind of. It's not full expensing for everything that you are going to be purchasing. It's for new and unused plant and machinery only. It will be for those items that qualify for the main rate pool of expenditure. So these are your drills, your big bit of plant machinery. For items like solar panels, which have been a big investment area for a number of our clients over the last 12 months, just to clarify, these are special rate pool items, regardless of what some people may be telling you. And so these only qualify for 50% write-off. So companies are going to have a think about whether or not they use their annual investment allowance against these items or benefit from the 50% first year write-off with the balance as a written down allowance over a period of time. As this is a first year allowance, expenditure on cars or plant and machinery acquired for leasing continue to be excluded from this relief. This isn't as generous as the super deduction and certainly not as generous as Mr. Hunt was making out. So in terms of other things, well, I've mentioned in my last speech about electric vehicle charge points. The government will legislate in the upcoming finance bill to extend the 100% first year allowance for the electric vehicle charge points to 31st of March 2025 for corporation tax purposes and 5th of April 25 for income tax purposes. This will ensure that the tax system continues to incentivise businesses in the charging infrastructure. So as of today, we've got 14 days to go for the super deduction. So don't forget about those assets that qualify for the main rate pool of expenditure. You get 130% write-off, but don't forget when you do eventually come to sell them, if you actually sell them for any money, there is a clawback. So if you buy it at 10,000 and sell at 5,000, that £5,000 is going to be uplifted by a further 30%. I don't profess to be a cultured man. I have seen The Lion King at the Lyceum Theatre in London, and that certainly was an experience, but thankfully the temporary high rates of theatre, orchestra and museum and galleries tax relief will be extended for another 2 years from April 23 and then will be reduced for the following 2 years thereafter. So for accounting periods on or after 1st of January 2024, these reliefs will be reformed into a refundable expenditure credit, which is something similar to actually the research and development expenditure credit scheme. The expenditure credits will be calculated directly from qualifying expenditure instead of being an adjustment through the company's taxable profits, as is under the existing regime. So there'll be 2 expenditure credits. There'll be audio-visual expenditure credit to cover the 4 existing film and TV tax reliefs, and then there will also be the video games expenditure credit. The video games, film and high-end TV will have a rate of 34%, animation and children's TV will have a rate of 39%. Productions that have claimed relief under the current system will be able to opt into the new regime, which is very positive. The current tax release will close to new productions from the 1st of April 2025. Films and TV programmes that have not concluded principal photography and video games that have not concluded development by 1st of April 25 may continue to claim relief under the current regime until 31st of March 2027. So share schemes, just a bit of a recap on what's happened here. So the SEIS scheme will become more generous with effect from the 1st of April 23, having that lifetime limit of 250,000. You're going to get an extra year in order to start raising that funding. And the gross asset limit and the individual investor limit will also increase. The company share option scheme, which was also previously announced, will increase the value of shares that can be granted to an employee from 30,000 to 60,000 with effect from the 6th of April 23. And certainly was a welcome change for us, the Enterprise Management Investment Scheme. We have an increased time to notify HMRC from 92 days following the grant of the options, and that is now changing to the 6th of July in the following tax year. So if you grant the options on the 6th of April 2024, then we're going to have until the 6th of July 2025 in order to notify HMRC of those options. All of these changes with regards to EMI are coming in from 6th of April 2024. Nearly there, guys. So the investment zones. Originally announced in the 2022 mini budget, the government has since refocused the programme, reducing the number of zones from 38, which is pretty ambitious, to 12. Each zone will have an investment package worth up to 80 million in order to invest, and the revised plans allow businesses in an approved investment zone to benefit from the following release for a 5-year period. As you can see there, it will be full relief from stamp duty land tax for commercial land and buildings. There'll be full business rates relief. There'll be 100% first year enhanced capital allowances for plant and machinery. There will be an accelerated structures and buildings allowances rather than the current 3% write-off. This will be a rate at 10% per annum. And there will be a relief from secondary class 1 national insurance payments for eligible employees on their earnings. So those who work in the site for at least 60% of their time. And that is up to £25,000 per annum for 36 months per employee. So extremely generous. Grant funding will also be available to those in a qualifying investment zone, which is there to alleviate barriers to productivity in the local area, for example, by supporting skills and apprenticeships, providing targeted business support and improving local infrastructure. The government is currently in discussions with local authorities on the investment zone proposals. The East Midlands is absolutely included, together with Liverpool, Greater Manchester, the West Midlands, the North East, Teesside, South Yorkshire and West Yorkshire. There are 4 additional investment zones also earmarked across Scotland, Wales and Northern Ireland with the help of the devolved administrations there. International taxes. I don't know if you know this cuddly guy, but he's Mark Taylor and he heads up Duncan and Topless's international tax offering, as well as that of Creston International. Duncan and Topless is part of the Creston International Network, which is a network of similar sized accountants across the world, a bit like PwC. If everyone in the network was to badge themselves up as Creston, we would be a top 10 firm. So what's changing? Well, it was previously announced, and just a reminder for those that do fall within it, transfer pricing. From April 2023, large multinational businesses operating in the UK will be required to keep and retain transfer pricing documentation in a prescribed and standardised format, which is as set out in the OECD's transfer pricing guidelines. So this is a master file and then a local file per country. This is there to give businesses certainty on the appropriate documentation they need to keep, and it also enables HMRC to effectively identify risks and more better conduct transfer pricing investigations. This is being legislated for in the Spring Finance Bill of 2023. The multinational tax top-up. So for accounting periods beginning on or after the 31st of December 2023, the multinational top-up tax will be charged where a UK parent company has an interest in local entities which are in non-UK jurisdictions, and the group's profits arising in that particular jurisdiction are taxed at a rate of below the minimum rate of 15%. The amount that will be brought into charge in the UK is enough to require that effectively minimum 15% tax rate. So if you're paying a 9% tax rate in a non-UK jurisdiction, you may find that you get almost a penalty in the UK in order to bring your overall effective tax rate up to 15%. No additional tax will arise in respective jurisdictions where the group's profits are taxed at 15% or more. As I've said on this slide, if in doubt, call an expert, and I'm more than happy to put you in touch with Mark Taylor. And I have cantered through, and that is actually the end of this spring budget. I'll now pass back to Nick Smith and others for a question and answer session.
Thank you, Matthew. That was excellent. Thank you. And I have to say, not just you, but also for Graeme and Christine. It has to be said, you know, I know what hard work you put into this, and I'm sure if we were in the public place, everyone would have given you a round of applause. So a digital round of applause for each of you. Thank you very much for doing that and updating us. Yes, indeed. A couple of points. HMRC team. I think we do have to have some sympathy with HMRC. It's not the individual's faults that their system is creaking, and I think we need to be realistic that really we have to adapt now to a new regime. We've got to adapt to the one too many campaigns. Matthew referred to that, and we've got to look, Christine, at the more strict penalty regimes. We're going to have to make sure we are more compliant, and I'm afraid that compliance burden is going to fall on taxpayers and their advisors. It's just the way it is. And good luck, Matthew, with your attempt to get the £1 million Manchester Prize for your science and innovation. I hope you achieve it. There will be more details, of course. I know at the moment the team have looked at the press releases. The actual finance bill will be published next Thursday on the 23rd of March, so we might get some more details then. In the meantime, yes, we do have two questions that have been raised, and the first one I'm going to start with you, Graeme, if you don't mind taking this one. This is from Sandra. I think it's Sandra Clements. Thank you, Sandra. The question is, do you expect applications for IP16 to cease at, you perhaps better explain what IP16 is, Graeme, to start with, but IP16 to cease at the 5th of April this year? Just thinking about protecting the tax-free, sorry, I think it should be, protecting the tax-free pension lump sum up to a possible £312,500, which in my simple arithmetic is 1.25 million, is it? I guess of total. But Graeme, if you don't mind, I'll leave that for you to answer, if you would. Thank you.
Yes, no problem, Nick. Thank you, and thank you for the question, Sandra. Yes, you're quite right. This is going to change the IP16 nominations that are made. So what this is all to do with is with the lifetime allowance having come down over various years. As I say, it started out at 1.8 million in 2011, came down gradually. And by 2016, it came down to £1 million. And at that stage, you can claim various protections for your pension pot. So if, for example, at 2016, your pension pot was already over £1 million, all of a sudden you're going to have a tax charge having done nothing wrong. You can apply for protection, which is what an IP16 effectively does. It's your individual protection from 2016. It effectively treats your lifetime allowance as if it was 1.25 million. So therefore, you can still make this election even years after 2016, as long as your pot was over the £1 million limit at 2016, and therefore that gives you this lifetime allowance tax-free lump sum of the 312,000, I think it was, that Sandra had mentioned, which is indeed 25% of 1.25 million. That's the effect of that. That's individual protection. On my slides, I actually had a footnote, which I think I forgot to read out, where the 268,000 limit that was quoted doesn't apply to protected pension pots. If you've already got protection in place or you're about to apply for protection, that can therefore increase overall. So if you've already got a protected pot, you're not now capped lower. You still have this higher capped pot overall. So for people who wanted to claim this protection going forwards, it's probably a bit more of a discussion, more of a question, because your overall pot can now go over the 1.25 million with the unlimited cap, and you can still contribute into that pension. So the people who are thinking about it from that perspective may still want to apply, or may not wish to apply. But yeah, the tax-free lump sum can be higher from 268 up to 312. So by applying for protection, you can therefore get more of a tax-free lump sum out of your pension. So it's a bit more of a conundrum. I think before was a bit of a no-brainer, and now it's a bit of a way up between how big you want your pot to be and whether you want the tax-free lump sum.
Graeme, thank you. While you were speaking, another question came in, which is, it was so wide open, I'm not even sure you'll be able to give an opinion on this at this point, but it's from thank you, John. John McMullen asks, is there an argument for taking a tax-free lump sum from a pension? While you're thinking about that, John's just put another question. I'll have to come back to that in a minute, John. There are so many aspects to this. You've got to think about your personal circumstances, haven't you? And there's all sorts of things in terms of inheritance tax reliefs and your own personal tax position and what you're going to do with the money. I don't know whether, Graeme, whether you've got anything that you'd like to add to that while I just read John's follow-up question.
Yeah, but by all means, I think it's a weighing up exercise. I don't think it's a crystal clear position. There's lots of advantages to taking the tax-free lump sum. Anything tax-free obviously always sounds great, and obviously not paying any income tax on that, which is wonderful. Whereas the rest of your pension pot, you will be paying it. But anything in a pension pot is outside of your estate for IHT purposes, which is a huge advantage to pension planning. So some people, if you actually don't need the income, why would you take it, even though it's tax-free? you might instead decide to leave it in your pension, benefit from that inheritance tax relief that you're getting from that, and leave it to grow in there and pass it on to the future generations free of IHT. That might be more lucrative planning. Obviously, it depends on your income requirements as well. You might want to speak to a financial advisor about this to get your pension forecast, what income you're going to need going forward. If you've already got significant personal investments, then why would you necessarily take it out of an IHT friendly vehicle? You want to leave it in the pension pot. Actually, if you need that income to live off, this might be a great way of actually reducing your ongoing income by giving yourself a boost further on, to line the coffers now while it's tax free, with a plan to reduce that over time and improve your estate in the future.
Yeah, that's great. Thank you, Graeme. And John's question was about the possibility of losing the IHT-free status and whether the tax-free lump sum does get removed in the future. So yeah, absolutely. And I think you're right. I think we're in danger of straying into advising perhaps on something that our friends at Castlegate ought to be doing, rather than us in terms of having an IFA to look at that. But yeah, in terms of the tax status, absolutely correct. So we do have one final question, which Matthew, I hope you've had a chance to have a look at. It's an anonymous question, probably because it's so difficult. But Matthew, could you please explain the difference between full expensing and the annual investment allowance, as they sound similar?
I can do, and they are similar, but there are some subtle and key differences. So full expensing is a first-year allowance, and it is a first-year allowance for new and unused plant and machinery that fall within either the main rate pool or the special rate pool. You have 100% write-off for items that fall within the main rate pool of expenditure. You only have a 50% write-off for those that fall within the special rate pool of expenditure. And in terms of full expensing, it is unlimited. The annual investment allowance, used and not new items that you acquire qualify for annual investment allowance, but you have a cap of £1 million, but it is 100% write-off depending on how you allocate it. So you could allocate your annual investment allowance to your special rate pool items and write those off in full up to £1 million, and then use your full expensing for your main rate pool items if they are new and unused. So those are the subtle differences between the two.
Great, thank you, Matthew, and yeah, thank you very much for the question, and indeed for those other questions as well. We are now at 11:27, a perfect time, and there are no more questions. So just leave it to me really to say thank you once again to our presenters today, Graeme, Christine, and Matthew. An excellent job, well done. In terms of everybody else, thank you so much for joining us today. It's been a pleasure to well, not see you, but to know that you're out there and that you're listening. I hope you have a safe and lovely weekend. Finally, a thank you to Will, the behind-the-scenes man who actually makes the digital thing work here. I have to say, yes, a nice little clap from us all. I have to say, without him, I don't think we'd be here. So thank you very much indeed to them. He will be sending you, anonymously no doubt, a follow-up on this in terms of can you give us some feedback. Always very helpful, and we look forward to seeing you again soon. At that point, I will say goodbye. Thank you so much for joining us. Goodbye.